Looking at gold. So gold's on pace for its best year since the 70s. The years that you gave us, 73, 79, those are the years after we abandoned the gold standard. So is there any correlation between those years and this year that we're seeing such a big gold rally?
Yeah, if you go back through the 70s till now, there's only been 4 times that gold's actually returned over 50%. So I think a lot of what we're seeing now is the debasement trade. So looking at largely central banks moving out of dollar assets and they're moving into gold. It allows them to not only hedge against what we might be doing economically, but also protect against trade wars and other geopolitical uncertainty that's going on in the market right now. Investors are just now starting to catch up to the gold trade, and we're really starting now to see flows enter into physical gold, whereas gold miners are actually seeing a little bit different story.
Yeah, you say when it comes to the gold miners, they actually have a very good dividend, and that's part of the action there. I want to go back to the actual metal itself. We often talk about the idea that it's people hedging away from the dollar, central bank buying, specifically China. Are there any other catalysts for gold in 2026 that can move it even higher after more than 50 record highs this year?
Yeah, I think when you look out through 2026, I guess the main question to ask is the conditions that we were seeing in 2025, are we likely to see a lot of those in 2026? So threats of declining interest rates, geopolitical uncertainty, and just overall geopolitical tensions. I think those are key drivers that are going to continue to persist out through 2026. And we see a lot of calls for gold to move higher. When we don't see, a large investor participation, it hasn't been until recently that we've actually started to see Western investors move into the trade. I think there still is some room to run there for physical gold.
All right, let's talk about the moves in silver. You say silver's been in a deficit for the last 6 years. So why are we just seeing this big rally recently?
Silver's always kind of been viewed as the little brother to gold. It tends to rally after gold makes its move, and we're into that second phase now of this precious metals bull market. The other aspect of that is it's really not just a precious metal. It's also becoming increasingly an industrial metal. And there's this new shift in the way that silver is being viewed. Those industrial applications are really increasing over the last several years here. And investors are just now, starting to see the silver trade. I think some of that is because gold has performed so well that investors have been content with gold and gold miners, but now they're starting to move into silver allocation as well.
All right. You say the miners, they offer more leverage than holding the physical commodity. But when you invest in the miners, you're also taking on their execution risk, their ability to run their business correctly, to sell and do other things. You say it's leverage, but as an investor, if like myself, like a retail investor, why would I want to hold the miners over the commodity when you're very bullish on the commodity itself? So why take on that risk of the actual company?
Yeah, we see, investors really look at, gold and silver in two separate ways. We have some investors that just like the physical component. Then there are other investors that like to take on that risk that comes with silver. When you look at the leverage that you can get through silver miners, if you look at the all-in sustaining cost of silver, it's actually below $15 an ounce for many of these miners. The difference with silver miners versus miners of maybe other metals is that most silver is mined as a byproduct. So really looking in and focusing on pure play miners is an area where we're starting to see investors really start to take an active approach in understanding what's in their ETF or in their fund holdings.
All right, one last thing I want to talk to you about copper, up about 35, 37% so far this year. Underperforming the other two, but still a really strong year for copper. Is that still levered to the housing market? If we continue to see mortgage rates go down and people willing to sell their houses or move to a different house, is that another potential tailwind for the copper market, or is that already priced in?
Some of that's probably priced in. The copper market has evolved over the last 4 or 5 years, where it used to be, very much tied to global economic health. We're starting to see copper really move out of that, and it's becoming an asset that's got a much more momentum behind it. We see things like the energy transition, where there's been almost $2 trillion of investment just last year alone. That provides this undercurrent of support that we didn't see, 5 or 10 years ago. The increased electrification, artificial intelligence, and the build out in data centers that we see there, all things that are adding to the demand for copper. At the same time, supply is constrained. We're not seeing new mines come online in any significant fashions, and we're actually starting to see several key disruptions across the copper industry, likely to push copper to a deficit this year. And if we're looking longer term into the medium and longer term, expect to see copper in a prolonged deficit as well.